Hey, good evening, Ken at Tortoise Capital. So we're going to continue with the 37 strategies discussions. Number 12, basic descriptive statistics. So descriptive statistics allow us to describe normal and abnormal behavior. So descriptive statistics, normal versus abnormal behavior. It allows us to identify moments in the market. You could think of these as critical states. When opportunities occur based on the imbalance between price action on both sides of the trade, meaning one or the other has gone abnormal. It helps us to estimate the limits of opportunities. So in other words, when we see an opportunity, we can project forward what the limit of normal response would be and when it would become abnormal, and to prepare for critical states when we see them coming, which can often be market turning points. Because it is math, it gives us an edge. See the previous discussions about know your edge. It's important not to extrapolate beyond the region of fit by trying to infer too much causality in what are essentially descriptions of behavior. So when you're talking about statistics, there's really two things that they're used for. One is to describe a population or a behavior or a set of phenomenon. And another one is to draw inferences. So a simple description is just to gain basic understanding of the underlying population. So if I have some kind of population and it exhibits some kind of behavior, I can look through my statistical lens, and from that I can describe certain facts and characteristics, height, width, temperature, average, degree of variation among that set. Sometimes there's a whole population, and what I'm trying to do is just take a reasonable sample of it, and from that draw either a description of or try to draw inferences about that population. All right. So the difference between describing and inferring is that I'm trying to predict, to draw conclusions about that population. Under the description, I'm just cataloging the features. In a world in which we have a lot of natural phenomenon, we expect that natural phenomenon is going to behave according to laws of nature. Nature doesn't really care what we think. It's just going to behave according to the laws of nature. So when we're looking at laws of nature, we're looking at natural processes that look like a standard normal distribution in many ways. And it gives us a reliability and a regularity to what a natural process is going to perform. And so when we can know the characteristics of this population or of this sample of the population, then we can not only describe it, but we can use it to say that in the future, we can expect in this new situation that given what we know about the statistics on this naturally occurring phenomenon, we can make some predictions about the number and frequency and type of behaviors that we could see out here. And if the population itself is too large to study, if we draw a proper sample, like a random sample, which comes from a bunch of randomly chosen events all around here, we can actually not only do the statistics of the descriptions of the sample, but we can use that to infer that because this is a properly drawn sample, that we can say something intelligent about the entire population given the characteristics and the statistics of the sample. Now, given the size of the sample to the size of the population, there's a little bit of risk associated with making that inferential leap from the sample to the population. And so you will hear of type 1 and type 2 errors, in which we draw improper inferences from the sample, or it turns out that through no fault of our own that the population or the sample characteristics were sufficiently divergent from the main population that we couldn't have known. We applied the statistics properly, but it was just the luck of the draw. So that's like a type 1 and type 2 errors. Now, the way we use statistics for our work is very strictly in the area of descriptions of the market, to tell us when the conditions are abnormal or normal compared to previous descriptions, but without making any claims about what direction or what the future might look like, only that we can say with more confidence that this is descriptively different than other normal situations, that abnormality is in the description, but without trying to say when that's going to correct or which direction it's going to correct, or to use historical probabilities to pick directions. We are not trying to predict the future. We're just simply saying that these conditions are descriptively different enough from the long-term normal that it wouldn't be surprising if something unusual were to happen. It could very well happen. And the reason for that is that when you're trying to draw inferences about a population, you need to be able to say things like, these are independent events that you're considering, that the previous series of events don't have any carryover power into time t, or the time now, what's happening, or what's happening next, that these are independent, there's no memory, and that these things are normally distributed, and that there's some kind of natural non-human intervention process going on in there in many ways. Well, when you look at finance markets, it fails all three tests. There really does seem to be memory of recent events that are carrying forward some kind of information, often called momentum, and that there does seem to be memory involved. And so without the independence, then you really run into the risk of trying to infer from populations and situations that are not justified. You're using the tool incorrectly. Also, the financial markets are not normally distributed. When you look at a standard normal distribution, what you have is something like inside plus or minus one standard deviation. You have about 1/3 and about 1/3 of the data. You have about 1/6 and 1/6 out to 2 standard deviations, and then out around 3 standard deviations, that tail is getting very small and almost insignificant. But in fact, financial markets in many ways are abnormally distributed, because there seems to be non-natural processes, and that the human intervention with memory and momentum are affecting things. So now, if we were to look at the distribution of returns, what we would see is that in many ways it looks like this. And there's two things to notice. One of them is that in the land between plus and minus 1 standard deviation, there's a lot more data clustered around the average, which means that when things are normal, they're really, really normal and almost more reliable that returns are going to fall inside that narrow band, even more so than in normally distributed. But at the same time, when you look out at the fat tails beyond Z3, in fact, the occurrence of events beyond Z3, between -3 and +3, which are almost insignificant in a standard normal, it goes to 0 pretty quick. Out here, you've got these persistent fat tail events, and we've actually seen 10 sigma events where something has been, where the probability or the size of it occurring is 10 times or 10 standard deviations greater than the average. Now, that is such a rare event in a standard normal distribution that you're only supposed to see that once every 4 or 5 times in the life of the entire universe. And yet, we have seen times like during the flash crash that we've seen 10 sigma events and 9 sigma events. And so what that means is a lot of this data, it's almost like it pinches inside here, and which pushes up, so it's squeezing that data. And so you get a lot more normal times that lures people into a sense of security that you can rely on these kinds of market returns, because most of the time, by far, they fall into that category. So a lot of long-term models really emphasize the stable returns that are available when times are normal. But they discount these fatter tails in which these very low probability events are not so low probability at all. They're only low probability when you consider a standard normal distribution, in which it is extraordinarily rare to see things beyond ±3. But in financial markets, because they're abnormally distributed, you get these unbelievably large deviations much more often than any predictive model could possibly predict. So one of the things that we're careful to do then is only to use statistics to describe current conditions, but without using it to try to predict what's going to happen. Now, if you look at long-term capital management, one of the reasons they blew up was that they were looking at models of financial returns as if they were normally distributed, and they were finding something that had 0.005 return, like 0.5% of advantage, and they were multiplying that by 200 times leverage in order to achieve results of something like 100% compounded annually. So they had a lot of mathematical wizardry backing them up. And so when people said, you math geniuses are going to give us 100% rate of return, and they said, yeah, well, that was working until it broke. And what happened was their models did not account for the fact that markets are not natural or random number generators and independently distributed. There actually is momentum in memory. And so what happened was, when they were trying to unwind very large positions, other market participants could sense, just like blood in the water, that somebody was in trouble. And then they would come in, and because of this momentum from trade to trade, they would start taking the other side and put these guys into a bind. And they couldn't unwind their positions, which they would have been able to do if the markets had been normally distributed. So you should read the book for more information by Lowenstein on, it's called When Genius Fails. And it basically talks about the problems of incorrectly using statistical reasoning for markets that are not independent, normally distributed, naturally occurring, because of the human factors in the markets and the artificial intelligence that scales rapidly that reflects human judgment. You have to be judicious and do not go beyond the limits of what your statistical tool is trying to show you. So now let me describe how we might use that to our advantage in a number of standard ways. So when we're looking at some of our standard statistical measures that are descriptions of conditions, it includes a number of ideas. So in daily trading, we talk about the standard deviation of range of the last 30 days, which allows us to compute the frog box, which is a description of the difference between signal and noise. So that if we have typical price action in here, but now we start getting a directional move, at what point can we say that this directional move is no longer noise, but has become signal? Where can we draw that? How far up the stack does it have to go before we can say, it has moved out of this noise box? So for intraday trading, we simply take the standard deviation of the last 30 days of range, and that gives us the frog box. So for the next day, that tells us what the frog box is, a difference between signal and noise. We take 70% or a factor of that to get the hybrid frog box. We also use the frog box as part of our range stat, which gives us the max reasonable intraday move, which says that if you take the last 30 days of range and you find the min and the max, and you compute the average, and you also compute the standard deviation of those 30, and you draw plus or minus 1 standard deviation around the average, then mathematically about 1/3 and 1/3 falls above and below that average, which is 2/3 of the data, and about 1/6 of the data fits inside here. So what we can say is that over a 30-day period, that about 50% of the days were between the minimum and up to the average, plus another 1/3, which is about 33%. So something like approximately 85% or 5 out of 6. 5 out of 6 times the ranges of the last 30 days were less than average plus 1 standard deviation. Only about 15% of the time, or 1/6 of the time, did it ever go beyond that. Now, we're not predicting that tomorrow it'll do that, but what we can say is that given the last 30 days of behavior, we can describe the daily ranges, the nature of the daily ranges in the following way. It said it would be normal for it to move an average distance up to 1 standard deviation beyond average, but it would be abnormal for it to be 1 out of 6 or 5 out of 30 to be one of those days where it went beyond that range. So we call that distance from 0 up to average plus 1 SD, we call that the range stat. And then that allows us to create the upper limit of the average intraday move when we're looking to make our trade. So if here's the open, and here is where it actually opened, we can say the maximum we could reasonably expect it to go in one day would be a plus range stat. And if it went down from there, the most we could reasonably expect it to move would be a minus range stat. And now that gives us the normal professional distance that it could move from the opening on a normal day. Now, we don't know that today's going to be normal or abnormal, and we wouldn't call it abnormal until it has moved more than a range stat away from the opening. Now, that gives us the ability to identify our professional trading space and our abnormal space. And so this is the land of irrational exuberance if it goes beyond a range stat. So how we treat money management in this range is different than how we treat it out here. Like if we've got a position on and we're making money and it goes beyond the range stat, we're going to make sure that we lock in all the gains from this side and not let the irrational exuberance cause us to believe so strongly that we let the price come back below the range stat to start eating away our professional profits. So we wouldn't allow it to do that. So this is how we're using descriptions of price behavior to help shape our strategic and operational and tactical response to price behavior. We're not predicting, we're simply ensuring that we know the difference between normal and abnormal using statistical measures. And that gives us an edge. We also use statistical tools like regression lines as the best fit line for a set of prices to help us understand the direction and magnitude of moves and to find a mathematically precise fair value on the basis of regression lines. We use 30-period Bollinger Bands of +1, 2, and 3 in order to define the Bollinger Band framework as part of the RLCOBB framework, and that gives us a way to describe how far away from the middle of the river, or the middle of the 30-period moving average, how far away has price moved, and then we can make an estimate of how normal or abnormal that move is. So when we look at the outer boundaries as ±3, and we look at the middle of the river as the z-square of 0, we can think of that space between ±1 as the river, and that's truly normal. On occasion, it will leave the river and get as far as ±2 to the edge of the floodplain, but it's really unusual to get beyond 2 and certainly abnormal to get beyond 3. Then all bets are off, and then when we see that happen, all the previous information and context from the last 30 bars is no longer valid, because the fact that it broke out beyond Z3 tells us this is all new and exciting, and that we should treat this as a special condition, an emergency event, and not to be fooled by all the previous price behavior. We use statistics in computing the regression line fractal frameworks, which allow us to compare the 10-period regression line price versus the RL270 to get a different view of short-term and long-term price holders. We use descriptive statistics when we're analyzing the ATR percentage of recent price action when computing market conditions. So it gives us an idea of how to make an adaptive statement about the description of the volatility of the market. We use descriptive statistics on these daily statistical measures of performance, like the gap stat, the gain stat, the fade stat, and the fail stat, all of which are measures of the statistics of how far things move from the open over the last 30 days to determine what would be the normal range of sell-off from the open, or the normal gains from the open. So we use descriptive statistics in that sense. We also use descriptive statistics when looking at the slope statistic, where we compute the slope of the 30-period regression line. So if this is the 0 line and this is the RL30, we can compute that angle, that slope angle, and say, compared to the steepest up it ever was and the steepest down it ever was over a look-back period, how steep is this current slope of the 30-period regression line compared to the max the average and the min, and we can compute a descriptive statistic to tell us how abnormal or how normal is this move compared to previous moves, and it gives us some sense of market description. We can then compare the slope of that instrument against the S&P's slope, and when we look back over time, we can see how much has this market or symbol ever varied from the S&P, so we can determine if this market performance or outperformance is unusual yet. So we use those descriptive statistics when we're looking at market conditions and relative strength. Most important of all of these is to say that we are emphasizing the use of descriptive statistics, not inferential statistics, and we think that's one of the things that gives us an edge on when to be prepared for really unusual responses to abnormal conditions. And when should we use the rule sets for abnormal conditions in order to protect against the increased likelihood of risky fat tail events. And so that becomes an important way to understand many of the tortoise indicators that you'll see us using. So number 12, basic descriptive statistics. That's one of our edges. And thanks for your attention.